Plug Power is currently trading at $3.42, down a staggering $0.36, a loss of 9.52% on the day. Now, a nearly 10% drop on a volatile stock like Plug might seem like just another Tuesday for seasoned investors. The common expectation is to see this as a buying opportunity, another dip in a long-term growth story centered on the hydrogen economy. But what you are witnessing today is not just market noise or a reaction to broader indexes. This is a direct, visceral, and panicked response to something far more specific and existential for the company. The reality hitting the market right now is that Plug Power, in its own regulatory filings, has expressed substantial doubt about the company's ability to continue as a going concern. That single phrase buried within an earnings report completely overrides the long-term narrative and forces every single person holding or watching the stock to confront a much starker, more immediate truth about its financial viability. This isn't about the future of hydrogen anymore, it's about the survival of Plug Power through the next 12 months. Let's break down the mechanics of this collapse. The general belief, the story that has been sold for years, is that Plug Power is on the cusp of profitability. The expectation was that their massive investments into building a vertically integrated green hydrogen network, from production facilities in Georgia and Texas to the fuel cells themselves, would soon start paying off, especially with the tailwinds from federal clean energy incentives. Investors, many of whom are retail traders using platforms like the Robinhood app or SoFi Invest, have been holding on, believing that the company's consistent losses were just necessary spending to capture a massive future market. They expected the recent earnings call to show progress, a narrowing of losses, and a clearer path forward. The reality delivered was a gut punch. The company reported a loss of 47 cents per share, significantly worse than the 30 cents analysts had projected. Revenue also came in light at $198.7 million, missing the consensus estimate. But those numbers, as bad as they are almost a sideshow. The real headline, the one causing this institutional and retail exodus, is the going concern warning. This is an official statement from the company and its auditors that they may not have sufficient cash to fund their operations for the next year. This warning has triggered a massive wave of selling, with trading volume today exploding to well over 150 million shares, dwarfing its daily average. This isn't just skittish, self-investing retail holders getting shaken out. This is a clear signal of institutional capital fleeing. Large funds and asset managers, perhaps those whose clients use services like Fidelity Wealth Management or automated systems such as Schwab Intelligent Portfolios, cannot simply ignore such a direct warning about solvency. The risk profile of the company has fundamentally changed overnight. It's moved from a speculative growth investment to a distressed asset. We're seeing a cascade of analyst downgrades hitting the wires, with firms slashing their price targets and questioning the entire investment thesis. For instance, Truist Securities downgraded the stock, citing the heightened liquidity risk and the uncertainty around the timing and substance of government loan programs. When the so-called smart capital heads for the exits with this much conviction, it creates a feedback loop of fear that's hard to stop. People who use sophisticated trading tools on platforms like Interactive Brokers Trading can see the order flow and the depth of the selling pressure, and it's not a pretty picture. To truly grasp the severity of the situation, we have to look beyond the daily chart and understand Plug Power's core business. The company operates in the hydrogen fuel cell sector. Its primary products are fuel cell systems that replace conventional batteries in equipment and vehicles, most notably in forklift fleets for major retailers like Amazon and Walmart. The grander vision, however, is to be a one-stop shop for green hydrogen. This means they are not only selling the fuel cell engines, but they are also building the infrastructure to produce and supply the green hydrogen fuel. This vertical integration is incredibly ambitious and astronomically expensive. They are building massive hydrogen plants, which require billions in capital up front with the hope of generating long-term recurring revenue from fuel sales. This is where the expectation-reality gap has become a chasm. The expectation was that government programs, like the Department of Energy's loan program and the Inflation Reduction Act's tax credits, would provide the cheap capital needed to bridge this spending gap. The reality is that these government processes are slow, complex, and the specific guidance needed to unlock these funds hasn't materialized in time. Meanwhile, the company is burning through cash at an alarming rate, ending the quarter with significantly less cash on hand than anticipated. This leaves them in a desperate position. They must raise a significant amount of capital in the very near future. The history of Plug Power stock is littered with periods of extreme volatility. It was a darling of the 2020-2021 bull market, a so-called meme stock that, together with names like Tesla stock or even some of the more speculative NVIDIA stock call options, captured the imagination of a new generation of investors using online investing platforms. Its price soared from just a few dollars to over $70 on the promise of a clean energy future. Since that peak, however, the stock has been in a brutal downtrend as the market's focus has shifted from grand narratives to tangible profits and positive cash flow, two things Plug Power has consistently failed to deliver. While other growth sectors have seen some recovery, Plug has continued to plumb new lows. This isn't a simple correction, it's a fundamental re-rating of the company's prospects based on its precarious financial health. Investors who bought into the hype are now faced with the grim reality that their investment is at risk of severe dilution or worse. The company has stated it is exploring multiple options, including new debt financing, equity offerings, or asset sales. An equity offering at these depressed prices would be incredibly painful for existing shareholders, as the company would have to issue a massive number of new shares to raise the necessary cash, significantly reducing the value of each existing share. So where does Plug Power go from here? The future outlook has narrowed to a few very distinct and high-stakes scenarios. The most immediate and critical hurdle is securing financing. The bull case, which is hanging on by a thread, rests on the company quickly securing a substantial loan from the Department of Energy or another source of non-dilutive funding. If they can get that capital infusion, it could buy them the time needed to get their new hydrogen plants online and start generating meaningful revenue. A surprise announcement of a major new partnership or a faster-than-expected finalization of the IRA tax credit rules in their favor could also serve as powerful catalysts. These are the hopes that the remaining bulls are clinging to. Do you think the Department of Energy will ultimately come through with a loan package for Plug Power, or are the risks now too high even for government-backed programs? Comment your opinion below. The bear case, however, is now the base case. The reality is that raising capital in the current high-interest rate environment for a cash-burning company with a going concern warning is exceptionally difficult and expensive. The most likely path forward involves a highly dilutive capital raise. This means existing shareholders, including the countless retail investors who have accounts with Fidelity, Robinhood, or SoFi, will see their ownership stake shrink dramatically. The risk of bankruptcy, while not immediate, is now officially on the table. If they fail to secure funding and their cash burn continues, they could face a genuine liquidity crisis within the next year. The market is pricing in this severe risk, which is why the stock is trading at multi-year lows. This is no longer a debate about whether hydrogen will be a key fuel in 2040. It's a question of whether Plug Power will exist in 2025. Investors looking at this space might compare it to the established giants. For example, an investment in Apple stock provides a fortress balance sheet, while Plug Power stock offers the opposite. Even comparing it to other high-growth tech like NVIDIA stock shows a stark contrast in financial stability and profitability. The comparison highlights the immense risk premium now attached to Plug. People who use online investment tools and investing sites need to be acutely aware that this is not a typical growth stock anymore. It's a special situation, a turnaround play with a binary outcome. In conclusion, the dramatic 9.52% plunge in Plug Power's stock today is the market's brutal repricing of risk. The long-held expectation of a smooth ramp-up to a green hydrogen future has collided with the harsh reality of a looming cash crisis, formally acknowledged by the company's own going concern warning. The narrative has shifted from one of ambitious growth to one of desperate survival. The path forward is fraught with peril, centered entirely on the company's ability to secure a financial lifeline in a hostile market. For anyone with an individual brokerage account considering this name,